Are you feeling stuck in your property investment journey? Because if you are, you're not alone. In fact, 89.5% of all real estate investors in Australia are currently losing money every single month on their properties. Now, over the last 13 years, I've been able to build a high 8-figure real estate portfolio and deliver over $170 million worth of real estate deals. And so in this video, I'm going to reveal just one simple change that you can make to your investing, which will dramatically alter your outcome and allow you to build a portfolio of properties that ultimately replace your income and generate a cash flow for you. So we've got to start by asking the question, well, why would someone want to lose money by owning a property? I mean, isn't the whole premise of investing to make money and to become wealthy? Well, in this country, we have a system which is designed to incentivize the private investment community to own properties that do lose money. It's called negative gearing. Now, why would our government offer that type of incentive? Well, when you really look at it, the residential property market in Australia is made up of 70% owner-occupiers and 30% tenants. So people that need to rent a property from a landlord to put a roof over their head. And that's typically because they either can't afford to get into the market or they just simply don't want to own a property and with all of the strings attached to that. So they choose to rent, and then they can live in a place where they want to live and, they live a great life and lifestyle. And so when we look at that, we've got to wonder, well, why is it that the government offers that? And that's because simply the public housing system just isn't large enough to support that 30% of the population. So they rely on private investors to then supply housing to tenants. So when you look at this, you think, well, okay, so what does that mean to lose money on a property? Why would someone still lose money? What is the benefit? And the benefit is that at the end of the financial year, if you've lost $15,000 by owning a property, that is the total rent that comes in from that property minus the total expenses, the interest, the property management fees, the insurance, the land tax, the council rates, the property maintenance and repairs. If you've lost money, right, so the income doesn't outweigh the expenses, well, then you can write off a portion of that on your tax and get that back at the end of the year in the form of a refund. And so that is the whole premise of this, is that you pay $1 to save 30, 35 cents in that dollar, which doesn't make any logical sense unless you are driving around in a red Ferrari earning $400,000, $500,000 as a lawyer or a neurosurgeon or an anaesthetist. Yes, you would have a tax problem because you're in the highest marginal tax bracket. So nearly 50% of everything that you make goes towards the government. So you literally work nearly half the week for the government first before you get paid. Now, most people, when you look at the statistics that own negatively geared properties, are not the high income earners. They're the average income earners. They're the nurses of our country. They're the teachers. They're the tradespeople. They're the bookkeepers and so on. They're typically earning $80,000 to $90,000 a year as the average salary in this country, and they own a negatively geared property. And that makes up 89.5% of the total investing population. They only own one, maybe two at a stretch, but they never get past that point. And then you've got to really ask the question, well, is owning one property or maybe two properties enough to put you into retirement? It's probably not. And so you've got to be doing more. You've got to be getting more out of your investing in order to position yourself comfortably for a good, solid retirement. And so when we look at this, we really have to understand, well, what impact is that having on our daily lifestyle? Because if you're earning $80,000 or $90,000, well, you're giving away probably $20,000, $25,000 of that straight off the bat to the government. You don't even see it. Your employer would be paying that to the government directly through your pay-as-you-go tax. And so you've then got to claim some of that back at the end of the financial year until you see some of that come back into your bank account. So with that said, if you're earning $90,000 a year and you've paid $25,000 in tax, well, you've got $65,000 left over to go towards your own living costs. So things like putting a roof over your own head and your family's head. That might be through the form of paying paying a mortgage or paying rent itself if you're doing the rent vesting thing. You've then got living costs like groceries and expenses, keeping the lights and the electricity going, keeping the air conditioning running during summer and heating, during winter. You've got to put fuel in the car. If you've got dependents, you might be paying for childcare. You might be paying for school fees. And so when you boil it down, there's not a lot left over at the end of the day. And so when you go and introduce a negatively geared property into the mix, let's say that's losing $10,000 or $15,000, there's just simply nothing left. So no wonder people get stuck only owning one, maybe two investment properties. There's simply just not enough to go around. Not only that, you're then sitting there waiting for the market to grow in value so that then you've got enough equity in that property to hopefully be able to refinance that equity out so that you can then go and buy another. And so it's these decisions which lead to people getting stuck in a phase which I call the abyss. It's like the complete darkness. It's the wilderness. It's very hard to move forward and to move into the next phase, which is what I call accumulation, where you're literally accumulating the right types of properties. And so if you're earning the average income, you do not have a tax problem, and you should not be investing in a tax incentivized scheme like negative gearing. Let's just step through a quick example so you know what I'm talking about. Let's say, for instance, you end up in a position where you've got enough equity in your principal place of residence that you can refinance that out to buy an investment property, or maybe you've saved up enough cash in savings to be able to buy an investment property, or maybe you've come into an inheritance or been gifted some money. Either way, you turn to Honey and you say, hey, look, we should buy an investment property. So typically speaking, the reason why most investors end up negatively gearing is because the person that they go to seek advice, their most trusted advisor when it comes to money, is who? Their accountant. They go to their accountant and they say, look, we think we've got enough for a deposit to get a property. We want to buy a property. Do you think that's a good idea? And the accountant says, yeah, that's a great idea. In fact, we should get you a negatively geared property so that we can then write that off on your tax. Now, why would an accountant, someone who's very clever and smart when it comes to money, advise of that sort of thing? And that's because the role of your accountant is to minimize your tax exposure. So it's what they're trained to do through university and through all of the associations that they're a part of, is that negative gearing is just the thing to do to write down some tax. And so it's not their fault that they've guided you down that path. It's just what they know, and it's how the system is built. And so if you're wanting to become an investor that makes money and that doesn't have to pay money to own a property, you've got to go in a different direction. So let's look at this for an example. Let's say, for instance, you go to just an average suburb to buy an average property, which is what most investors do. So this one's here that I've chose, which is about 50 k's out from the Melbourne CBD in a place called Cranbourne East. Pretty straightforward property. You could get into this thing today for $700,000, and then you'd expect to pay around $42,000 in purchase costs. These are costs that are made up of things like stamp duty, conveyancing, legal reviews, building and pest inspections, and so on. So it's roughly around 6% of the purchase price itself. So in order for you to get into this deal, you'd have to tip in $182,000 of your own money, and then you're going to go and borrow $560,000 from a bank. And you're going to be paying roughly 6.1% interest in the current environment, which means that you'll be on the hook for $34,000 per year. Now, if we look at what the rental return would be on a property like this, you're probably talking 4 to 4.5% as a gross return on the investment. And in an area like this, you can typically expect around $600 per week in rent. So when we calculate all of that, you're getting roughly $31,000 per year in rent, which puts you already behind the 8 ball. Like you're already in the red before you've even factored in all of the other costs associated to owning the property, like property maintenance and repairs, insurance to protect you as a landlord, council rates, land tax, COVID recovery tax, and so on. And so when we factor all of that in, at the end of the month, you're probably writing a check for around $740, $750 to own this property. Let's call it just under $10,000 per year, $9,000 to be more precise. And so you might be sitting there thinking right now, yeah, that's all great. Like, I'm happy to lose money today for a future benefit of tomorrow in the form of capital gains. But what does that really look like? Well, let's step it out. So let's say, for instance, you bought the property in 2024 for $700,000. What we want to do is use history to determine what might happen in the future. It's not crystal balling, but it's making our best guess estimate to what the property might do and the value that it might be in, say, 10 years from now. So if we just dig up some data here from CoreLogic, we can see that this area, this suburb, has been performing at 4.5% per annum in growth. So if we apply that same rate over the next 10 years, we could expect that that property's value would be sitting just under 1.1 million. Awesome. We've got a $400,000 equity gain here. Now, is that $400,000 all ours? No, it's not. Because if we go and sell that property in 2033, we're going to be up for marketing the property, selling the property through an agent. So we're going to pay roughly $27,000 just to do that exercise. And then we're also going to get hit up with a capital gains tax. So we could expect to pay $55,000 just to the government out of that equity benefit that we're getting. So that dilutes our equity return. And then we've got to look at adding back the tax benefit. So if we've been losing $9,000 every single year to own that property, it doesn't factor in any rental growth either. So it's just baseline figures. Well, then we're going to be getting roughly $2,800 back per year on our tax. So over 10 years, that works out to be $28,844. So our total then estimated equity benefit sits at $340,000. But don't forget, we've had to pay out of our cash flow that $9,000 each year, which means that we add back in total annual benefit of $25,000 per year back on our equity. So a 9.5% equity return. So as an investor, you've got to be asking the question, well, would you be satisfied with a return like that? For taking all of that risk, for having to pick up late night phone calls to the property manager and to have to organize trades to go in and fix a hot water service when it breaks down, and, to have to go through the pain when your tenant doesn't pay the rent for 3 months because they lost their job. Like, all of this are the things that just happen in owning an investment property. And the reason we own an investment property is to get an adequate return on taking that risk. But the question is 9.5% an adequate return? In my opinion, it's not. You could be investing in far better asset classes for that matter. Private equity funds, managed funds, public equities markets, where if you look back over 40, 50, 60 years of history, just the baseline average returns that you could get in those asset classes would outperform this 9.5% return, and you didn't have to do anything for it. That's net after fees. And so what would you prefer? To just have some passive income that's coming through that's managed by a very experienced manager, or taking the risk on this property that it may not continue to grow in value either? Or do you go to something that can generate a far better return in property? Because I can tell you right now, there is much better options out there. So what does this look like in real life? Well, I want to introduce you to Sarah and Chu. Sarah and Chu came and worked with me a few years ago. And when they came to me with this portfolio of negatively geared properties. And so what had happened is that they had leveraged up their principal place of residence to get the equity out to then go and start building a real estate portfolio. But the problem here is that they had gone and bought all the wrong properties. And so they had a couple of apartments in their portfolio. They had one house and land package, and they were losing money every single month on each of those. And so they were having to work full-time, massive hours in corporate jobs while managing young kids and managing the household and having to pay a mortgage of their own, which was geared up to 80%. And so for them, they just felt stuck. They didn't feel like the decisions that they had made were advancing them financially forward. And so when we looked at the portfolio, I said to them, guys, like, you've got to go and do opportunity cost analysis, which is an exercise that I teach people to do, where you've just got to deep dive on every single property and just rip it apart, dissect it on the table, and then come back to me and show me and tell me why you should keep these properties. And after 3 weeks, we had another call, and they basically said to me, look, we just don't have enough reasons to keep these properties. We think that we should sell them. We're going to take a small haircut, but what it's going to allow us to do is reduce down the gearing on our principal place of residence, which is going to release the pressure valve. And so they went and did that. And then what we did was reposition their whole portfolio so that they didn't have high non-deductible debt in their principal place of residence, but they were then able to go out and invest in what I call forced equity strategies, which were then bringing in larger chunks of cash back into their portfolio, which then freed them up time-wise. It meant that then Sarah could go and start her own mortgage broking firm. She's then living a life of more fun, more freedom and flexibility, working with clients that she enjoys. She's got more time for the kids and ultimately is just far more happier in this new situation, and they're making far more money. And so that's the difference between investing in negatively geared assets that are reliant on you and your cash flow to keep them sustainable versus cutting all of that out of your portfolio and investing in projects and properties that you can add instant value to. And that is really the difference here. It is not about paying $1 to save 30 cents. It's about being smart with your money and deploying it in areas where you know you're going to be able to get a sufficient equity return on your money for the risk that you're taking. And so if you're sitting there thinking, okay, well, what's this forced equity system that you're talking about? Forced equity is literally being far more strategic around the assets that you introduce into your property portfolio, which allows you to add instant value to them in the form of equity. And that's simply by applying a strategy like subdivision, construction, renovation, strata titling, buying under market value, maybe going and getting a permit for a higher and better use, and then going and taking that property either back to the market, selling it off and taking the profit off the table to then roll into your next deal. Or if you've been able to create a property that now is positive cash flow, or at the very least washes its own face and is neutrally geared, you then take that property back to your lender with a new and improved valuation. You refinance that property and draw out your original equity. And it's this process that actually allows you to then move forward to the next deal while that property then sits there in the portfolio nicely, growing in value over future years. That is the difference to what the smart investors are doing versus the ones that just get channeled into a strategy like negative gearing, which ultimately just holds them back and keeps them stuck, boxed into a corner where they can't move ahead. And so if this sounds like you, then you're in the right place, because ultimately it doesn't take a lot to reposition and get redirected down a new path. You've just got to apply a lot more strategic thinking and have a roadmap of how you're going to do it, and then apply yourself to that roadmap and take action. Most people don't have any problems taking the action. It's just that they're uncertain or unclear around what the action steps really look like. And so if you're wanting to get a bit more clarity on what your action steps look like, we offer complimentary strategy calls to Australian real estate investors that are wanting to improve their situations in their portfolios. So that we've dropped a link down below in the description where you can go in, find a time in the diary that works for you and book that in today. And that will be one step that you can take, which will get you closer to achieving your real estate property goals. Secondly, if you've enjoyed this video today, give me a big thumbs up. Go and subscribe to the page. There's going to be lots more videos that are coming out, which are educational and which will help point you in the right direction. I hope you've enjoyed that. Bye for now.